Hey, good morning, everyone. My name is Aaron Vandeford, President of Entercom, and I'm excited to be joined by Dave Anderson, Senior Equity Analyst covering oilfield service and equipment at Barclays Capital. Good morning, Dave.
Hey, Aaron, how are you?
Doing well. Hey, I'm really glad that you were able to join us here for this session. Wanted to dive into what you're seeing in the oilfield service side of the business. Certainly, we live in interesting times here, and appreciate your perspective. And so, maybe I'll just ask you to begin here with some high level observations, and then we'll dive into some questions.
Sounds good, Aaron. Happy to do that. So maybe just a little bit, just in terms of how we think about the world right now, is kind of a little bit of a setup for kind of what we're focusing on these days. So I cover the global oilfield services sector for Barclays. We're very global in nature here. We focus on every market that's drilling globally here. We cover 25 names. We've lost a few over the last few months. We're probably going to lose a few more coming up here. But just kind of in terms of how we think about the world in terms of our investment framework, for us, it's all about upstream spending. So what we really care about is E&P spend, E&P CapEx spending out there. That is essentially the revenue that we're paying attention to. We're looking at North America, viewing that as the shortest cycle on the planet here, high decline rate market, highly commoditized in services. International land, a longer cycle market dominated by NOCs, and then offshore, the longest cycle of all, but the one that's been in decline since 2014. So happy to talk about any of that as we kind of get into that. But I just thought, just in terms of your audience, and I've been out to Entercom many times in the past. I used to be an E&P guy, so I know your audience pretty well here. So I have a feeling they're going to want to talk a lot. I want to listen a lot more about North America. So maybe I'll just dig into kind of how I'm thinking about North America right now, and also what we learned in the first quarter, which just wrapped up here. So first of all, I think it's really important to people to recognize. I'm sure a lot of your participants in your conference are aware that we were really already on the precipice before COVID happened, before the oil price crash happened. Frankly, a lot of E&Ps couldn't make shale work at $50 oil. Services in general has been steadily commoditized over the last 5 years, really in this race towards efficiency and improved completion techniques that really kind of steadily eroded the services intensity, really at the well here. So with no scarcity value, pricing for services has been anemic already. And then the oil price crash happened. But this is not an oil price crash that is really analogous to 2014 or really even the 2008 crash. This is really something much, much more significant. This is really the 1986 crash all over again. 2020 represents, in my mind, the end of a 35-year cycle, or it's also going to be viewed as the beginning of a new cycle, but one we think is going to be much different than in the past. Whereas the golden years of the 2000s were driven by steadily growing oil demand and search for hydrocarbons, and we might remember the peak oil years back in those days. This cycle is going to be marked by slowing and then declining global oil demand and the need for efficiency, low cost, and more environmentally friendly solutions. The common denominator between post-86 and post-2020 will be technology. The last cycle, Schlumberger really led the industry applying technology across the globe to unlock deep water, Middle East resurgence. This time around, it's going to be about digital software, applications that can improve drill plans, reduce drilling times, cut down on unplanned drilling time, predictive maintenance, taking people off the well site. And I'll get into that in a little bit. But of course, the key for service companies is to get paid for this, which investors are very rightly skeptical of whether or not they can pull that off. So kind of back to the near term, everybody knows what happened to the rig count. And the last numbers I saw, so we peaked at 781. I think we're at 235 today. We heard kind of pretty much throughout earnings that the U.S. activity has really kind of bottomed in June, is coming off the bottom a little bit since then. Every single one of the pressure pumping companies that we spoke with are down to single digits in fleets in the second quarter, including Halliburton. Now, overall, that could double in the next 20 days, but it's pretty small numbers we're talking about. Overall, E&P revised budgets really didn't move much from what we thought before. We're looking at about down 50% this year. Essentially, the industry is reaching what we call a maintenance level in spending. This is essentially the spending that'll keep production flat going forward into 21 and probably 22. So we're expecting activity levels to essentially plateau at the end of the third quarter and stay there well into the first quarter. Right now, we're projecting the rig count to be, maybe something around 300, maybe 350 a year from today. That 350, though, is going to be really probably much more on the oil price or oil price driven if we come close to that number. But the fact is this: North America is going to be a structurally smaller market. We believe around 2 million barrels a day of production will be permanently impaired. This has frankly been a reckoning for much of the E&P industry, and we believe $50 a barrel only works with those who have scale and the more mature programs that can generate consistent cash flow. The days of outspending cash flow by 40% a year in and out are over. So we think, and as it relates to services, it's going to get much worse in the coming quarters. I keep hearing this consolidation theme being talked about in the pressure pumping side. I have yet to hear a convincing argument for that consolidation, other than just tying two lifeboats together to survive the storm. We believe much of this industry was over earning the last several years. Now too many have massive leverage problems and very little business differentiation. But here's the positive side to all this. This is a painful but very necessary process. The oil field inflation of the late 2000s and early 2010s is coming fully out of the system. Very little CapEx has been spent in this industry over the past several years. Hardly any replacement equipment has been built, and attrition is taking its toll. So we think services could start coming back into balance, maybe by mid next year if everything kind of breaks, but we're probably looking at the back part of next year. But this is also a huge opportunity for digital solutions. A few years back, it seems as though every E&P company that we spoke with was talking about analytics or data analytics or hiring internal data teams. Today, we hardly hear anything about that. And why is that? I think first, investors don't want them spending the money on science projects. They want free cash flow. But second, I think a lot of E&Ps have realized this is not in their DNA. Developing and implementing software solutions is an entirely different skill set. So we've seen a steady shift of intellectual capital move from the service companies to the E&Ps over the last 10 years. We think that's going to start shifting back towards services led by digital over the next 2 to 3 years. So finally, I'll just end with a few thoughts on earnings and kind of what we've learned and kind of where we think we are right now. For the most part, the most important aspect for us was determining where is that new normal of EBITDA in third quarter and fourth quarter. It's pretty clear that North America bottomed, and what international is going to take a couple more quarters until we kind of reach that new equilibrium. We're expecting overall global activities to remain flat well into 2021. Our overall spending numbers are showing that U.S. is going to be down, North America will be down about 50% this year in spending, international down 15%. Preliminarily, we're expecting North America to be down another 20, probably 25% next year as well. International down probably single digits. But the big service companies, I think the most important thing, the other important thing we saw is a lot of cost out coming out of these programs from service companies. The early returns are very, very impressive. They had a head start on this from last fall, so they didn't just all of a sudden just start these plans back in March. These have been ongoing since last November. They just accelerated these programs. So I would say overall investor sentiment has been improving. That's not saying much considering everybody kind of left my sector for dead, all kind of pretty steadily over the last 6 months. So I think there's a lot of companies out there that are positioned that have real businesses that are resilient, differentiated, and well positioned for the recovery. Our favorite names right now are Schlumberger, Baker Hughes, and in the mid-cap side would be ChampionX and NESR. So Aaron, why don't you leave it right there and we can kind of go into Q&A. I think that was kind of a general overview of kind of what we're thinking in terms of the market.
No, that's perfect. And this great background. I appreciate it very much. I want to dive a little bit more into the technology side of things. And you mentioned, that intellectual capital that was in the E&P moving back towards maybe some of the oil field service. And we've seen over even the last little bit, even, your Microsofts partnering with oil field service companies. So real tech coming together. How are they prepared, or are oil field service companies prepared to make that technology advancement? And what are they going to need to do here to make sure that they can implement that successfully?
So we've seen the big tech come into this space over the last kind of 18 months. As you mentioned, Microsoft is in there, AWS has been there, Google a little less so, but Microsoft has been sort of leading the charge here. For the most part, it's been on the cloud side. So effectively is taking all the information and trying to make it readily available throughout the organization been the first and foremost part of this. But then what we're seeing on top of that is ecosystems being built. So Schlumberger, Halliburton, NOV, companies like that have built these basically what we call these ecosystems that are driven by the cloud, but create these platforms for the customers, meaning the E&P companies, to improve on the drilling side or the completion side or even the production side. And what we're seeing is applications being added in there. So really what we've seen is this proliferation over the last 12, 18 months of what I would call the marriage between Silicon Valley and domain expertise in the oil and gas community. In fact, there's a lot of former Schlumberger guys who are out there who are building up a lot of these software companies. We've tracked a number of them. And I would say, in terms of the companies we've met with, and we've met with a ton of them, they're beyond the proof of concept stage. I mean, they have proven this actually works. The trick is getting it into the workflow and to getting that part of the day-to-day business and getting the E&P customer to trust the software and whether or not it's creating a new drill plan, completing something a little bit faster, allowing the rigs to work more autonomously. This past quarter, you heard all the big service companies talking about digital. They'll talk about it a little bit different way. I think it's really, really important to make sure we know what we're talking about when we're talking about digital. Now, there are companies out there that do a lot of supply chain management. We hear that quite a bit. That's not really what we're talking about. That's pretty low-hanging fruit, frankly. I think you should be able to kind of manage that pretty effectively. For instance, if you're procuring sand down into the Midland, getting that and trying to get the right crews, I think that's all pretty easy. I think trying to plan that next well is tricky. I think trying to find you have basically 4 guys on the rig side today who are drilling. We think you can get that down to 1. So last quarter, Baker Hughes said 70% of the drilling operations had some form of remote operations built into it. So they went from 4 down to 3, but they say you can go from 4 down to 3 down to 1 eventually. And I think that's sort of what COVID is also allowing us to do, is I think it's actually becoming an enabler for digital to start coming out there. So digital comes in many, many forms. Some of the most exciting parts that I actually see are downstream. In the midstream and downstream markets, where you have predictive failure, that can really improve efficiencies, and the maintenance side can be very, very predictable going forward. And every time I see some sort of disaster that seems to happen in West Texas, of some plant gets blown up or something, that's all very, very preventable. And I think it can all be happening with data analytics, artificial intelligence. So I think we're moving pretty quick. Our guess is we think we're in kind of second, third inning, but it's being rapidly adopted, we think, across. The question is just, when does it get into the workflow?
Yeah, and I think that it's really interesting as we're having more and more conversations with some of our clients as well. This COVID era is really getting people a little bit more comfortable in some of that technology and even the cloud. And so that may be an accelerator. So that's an interesting point. I want to not necessarily shift gears, but as we think about valuation of where companies are, certainly oil field service valuations have come way off. They're not tech valuations, but we're getting more tech based. When do you guys see valuations maybe coming back to a pre-cycle level? And do we see oil field service valuations, or do you guys see oil field service valuations maybe moving up a little bit higher than where they may have been with this tech addition?
Well, valuation is a little tricky right here, particularly at a trough, right? So trying to figure out what a stock should be valued at on 2021 EBITDA that's pretty tough. You really need to look out to 22 to try to get a little bit normalized sense. And the research that we've done, and I think the good thing about those 2008, 2014, at least it gives you a guide on valuation. And what we've seen is that in the past, these stocks can trade at a 30, 40% premium on that next year, on that trough multiple versus what they were before. That's kind of where we are in a lot of these companies. But I look at a company like Halliburton, and for me to understand how to justify where it's trading, I need to understand on that kind of DCF of kind of what's being baked into that stock in 22 and 23. And I think this is a really crucial aspect here. In past 2 downturns, you've seen spending increase in North America 30 to 50% in the recovery years. I don't think that's going to happen in 22. As I said, I think this is a structurally smaller market. So for North American companies, I actually think they've gotten ahead of themselves a bit. But when I looked at some of the other companies, like the more international based companies, I think some of these names actually look rather attractive. I think the tricky thing for us is some of these differentiated names like production chemicals. How do we put a multiple on those businesses? But getting back just sort of that relationship between valuation and the financials, it always comes down to returns. So getting back to your question, if digital does come into play, I think what you're getting at is if these companies like Schlumberger or whatnot start building up more and more software and digital, what does that mean to valuation? It should mean an upward lift to valuation because there are fewer people, much higher returns, and the margins are phenomenal in software sales. And that's sort of the other thing is what we're seeing here is where Schlumberger was selling on-prem licenses 10, 15 years ago for Petrel and Eclipse. Today it's all subscription based. And that's the other big thing. So it's a recurring revenue stream. But one of the things about these platforms, though, it also gives them a look at the applications. So the other key thing which happened back in the 90s was consolidation. Yes, there was a lot of consolidation among service companies, but the key thing is there was major software acquisitions done by Schlumberger and Halliburton that catapulted them into the 2000s. That's what we think is going to happen again right now. And I think you're starting to see a lot of jockeying around, okay, who's got the right technology, who can scale that up? Because if you can do this right, yes, it has a very, very big influence on your returns and should therefore also be on valuation. I very much agree.
So let's stay on that M&A and consolidation topic for a second. As we think about, you mentioned in your comments that, there's not a lot of catalyst maybe for the E&P consolidation story to come together. What about on the oil field service side? You mentioned that maybe on the technology, but what's going to happen to the iron that's maybe been put laid aside for right now? Is there a market for that type of
where's
stuff?
that going to go? Well, Aaron, I want to make sure we clarify. When I was talking about M&A, I was talking about services. I wasn't talking about the E&P side. So I leave that to my colleague Janine Way on what she's talking about. I'm not encroaching on her side.
Well, thanks for clarifying.
I used to be an E&P guy, but now those are my older days. No, on the services side, look, that's exactly where I struggle. And I think a lot of people looking, hey, all this consolidation in the 90s, post 86, that same thing's going to happen. No, hold on a second here. Back in the 90s, you saw the consolidation because a lot of service companies were having discrete business lines, and they were building out and they were going more global. And that's why you saw Halliburton buy Gearhart, and National and Oilwell got together. Baker Hughes all got together. That's not going to happen again. And I think what we're seeing right now is everybody keeps talking about consolidation on the pressure pumping side because everybody's dying for it to see. I can't come up with a business case for it. Why am I going to buy somebody else's iron for even 50 cents on the dollar if I know I just have to plow that back and I have to spend all that maintenance capex? And that's the dirty secret of pressure pumping, is that these are really 5-year assets. 5-year assets that require a lot of maintenance capex to keep them going. So it really doesn't pay. When you're making an acquisition, you're just buying somebody else's iron. Everybody's kind of doing the same thing, Aaron. It's not a big differentiation. Yes, you have your tier 1 players. I still say that ProPetro and Liberty and Halliburton are in a tier 1 player. But man, that difference between tier 1 and tier 2, that's really closed. And there's a whole bunch of players down in tier 2. So to me, it's very, very hard to make that argument, at least to say you're going to be adding value. The only rationale would be on scale. I'm not even convinced scale is working right now. So I don't see a great business model for that. The only kind of consolidation I really do believe in services is going to be around certain very differentiated business lines. I think you could definitely see some maybe around the artificial lift side. I think there could be some stuff on the drilling side and drilling completions and things in that area. I just think the completion side, there's just no scarcity. There's no scarcity out there. I think we need to work that down. So I'm not very bullish on a consolidation theme for driving this group going forward.
No, and that makes a whole lot of sense to me. As we think about certainly a smaller market, as you put it, what does that mean maybe on some supply chain logistics or for some other basins that may not be the Permian that has a whole bunch of other supplies? I mean, we saw at least 1 week where there were no rigs working in Wyoming. And so what does that mean for maybe some of these other plays and service operators?
I think we're seeing, we've seen sort of a cottage industry of a lot of smaller service companies proliferating over the years because all it required, just required a little bit of capital, and you and I could be in the pressure pumping industry tomorrow. So I think you've seen that kind of spread out quite a bit. And I guess what I'm worried about is I'm looking at a lot of those E&Ps, particularly the privates, who, it's tough to get a real read on them. Yeah, we talked to some of them, but man, there's just hundreds of them out there. So it's really hard to get a good handle on it. But I have to think a lot of those guys are really struggling right now. And I talked to NOV, and NOV's customers are the service companies, and they're pretty worried about a lot of their customer base. It's not Chapter 11, it's Chapter 7. And so I think you're starting to see, look, we don't have any supply chains issues today, right? And the big reason why is because the rig count fell by 70%. So it's not like anybody's having trouble getting anything today. But I think what you're getting at is when things do kind of normalize, what happens then? And I think you're going to see things will start to tighten up right now. I think there's more than enough. But look, I look at say pipe, like OCTG pipe with Tenaris. man, there's 16 months of inventory out there. 16 months. It's normally 6. So that's just going to take a long, long time to work down. So I'm not terribly worried about it today. But I do think a year from today, that's when things are going to be kind of stretched out. And the companies that have the balance sheets that can withstand this, yeah, they'll still be last man standing. And I think that's going to be particularly for basins like Wyoming, which certainly aren't what they used to be. I mean, the days when I was covering ultra petroleum and looking at what they were doing out there, those days are long gone. So yeah, it's going to be tough. I mean, I guess the other area, probably the Northeast, I'd be worried about. I mean, the Northeast that's a tough area to get around to begin with. It's not easy to get around. There's a lot of bridges and small roads and stuff. And a lot of the bigger service companies have already left. And so you have a handful of players out there. So yeah, I think some of those players, those basins outside the Permian could be a struggle and probably could see some cost pressure just from struggling to get supplies. But it's not something to worry about today. It's kind of a second quarter 2021 issue to think about, I think.
And that's good perspective. You guys obviously, and you've mentioned it a lot, your firm and you do a whole heck of a lot of work on the spending, and you guys come out with an annual report that I think is probably certainly the most well-read and most respected. As you think about where E&P spending, and I want to stay more domestic here, and then let's touch on some international, but what is it that it's going to take the industry to spend, or what are you hearing from those folks to spend more? Is it a dollar amount? Is it lower oil field service prices? Is there room to go lower on pricing? What is it that's going to drive that?
There really isn't much room to go on pricing. Although I guess you can always go a little bit lower. But I think a lot of the guys in the industry that I speak with, a lot of people learn their lesson about when you go down to cash break even, why am I running this? What is the point of running this equipment? Once again, I go back to if I have a 5-year asset life, why am I going to spend a year of it making zero cash? It makes absolutely no sense. So I think there has been a reckoning, because don't forget, the service companies aren't spending CapEx either. But I think it was at our conference a couple of years ago, I think it was 2 years ago, we first started really hearing about capital discipline. So one of the things that we spent a lot of time on looking at is what I call the plowback ratio. So just looking at CapEx relative to operating cash flow for the companies. And one of the things that we noticed is that for the last 15 years, there was a stretch in which the mid-cap E&Ps, over, as I said before, they spent somewhere between 140, actually 160% of cash flow for a period. Most of the big guys consistently spent over kind of 10 to 20% over cash flow. But clearly investors have really, really pushed back on that whole notion. I also think the whole idea about growing just for growth's sake has not worked. And clearly you've also had a big pushback on investors telling the E&P saying, hey, your board of directors, you're not aligning yourselves with us. We don't want your incentive packages to be on growth. It needs to be on returns and cash flow. So I think that's been a big, big change in the fact and how we look at it and how we look at spending going forward. So I believe I don't remember the numbers right at the top of my head, but I think we looked at last year, the industry only spent something around, I think it was the 90% of cash flow last year. That was the first time we've ever seen. That was a major, major change in behavior. So I think you're seeing a big structural change in behavior of the E&Ps. They're certainly not getting rewarded for growth. Frankly, I'm not sure what they're getting rewarded for. And I think investors are getting pretty frustrated. So I do not see that spend going up, even if oil prices get into the 50s. I mean, our bank thinks like that threshold is something around the mid 50s number when you'll start to see more activity happening. But even then, I think it's going to be short-lived, frankly. So I'm not very encouraged, frankly, in terms of what North America is going to look like in terms of spending, but just the trajectory and how it's fallen so fast this year. I mean, to even be flat next year is frankly impossible. So our best bet is we think it's down 20%, and then kind of look into 21. Maybe you get kind of single-digit growth, kind of high single-digit growth, maybe low. It's kind of a little bit too early to say, but we just kind of, once again, we're kind of tracking behavior, and I think a lot of it's going to come down to a year from today. Are we talking a $40 oil price? Are we talking more mid 50s? And so it's a little early to call on that one.
Yeah. So let's cross the border a little bit into the international scene, and we certainly heard from many on the Q2 calls that there was a little bit more resiliency in the international revenues. Tell us a little bit about the international side of the space, and is that resiliency maybe a little bit longer term, or is that at risk as well?
So when we talk about international, it's tricky because you have to talk about so much. Let's break that down a little bit in terms of international. We're talking. Look, there's obviously a big offshore component to international. That's not looking good. I mean, we think is the look. If we look at the overall floating rig count today, it's around 125 floating rigs. We think by early next year, we're talking less than 90. I mean, of all the companies I covered, only one of them has not gone bankrupt. That's Transocean, and things are looking a little tough there as well. So that's a market which we don't expect to turn until 2022. Latin America, it is a disaster right now. I mean, every single market right now. Argentina rig count is, I think, is at 2. It was at 70 a year ago. Mexico is just a mess. Ecuador, Brazil is okay, but pretty much most of Latin America is really, really tough. That's the bad news. The good news is the real resiliency is in the Middle East. I had my last international trip was actually the end of March. The end of February. Seems like it was 2 years ago. I was in Saudi. I spent a week in Saudi. I was with Sharif Foda of NESR. They're a pure play service company, a pure play Middle Eastern service company. Sharif used to run Schlumberger's Middle Eastern business for a long time. That is a market which is extremely resilient, just in general. When I say Saudi, when I say Middle East, I mean Saudi, Kuwait, UAE, Oman. These markets are really, really resilient. Something a lot of people don't realize is it's actually a gas market. The Saudi rig count, 60% of that market is actually gas. And that is absolutely crucial to the ambitions of the kingdom for what they're trying to do industrial wise in terms of what they're trying to build up the kingdom. That is not changing. So what I just heard, yesterday, the budget was announced on Saudi Aramco, and they put out a press release, and they showed it went from 25 to 30 billion down to 20 to 25. What they don't break out is downstream versus upstream. That's a pretty crucial fact. Now, they're not going to tell you everything is out there, so you have to kind of make a bunch of calls and talk to who's on the ground. But essentially what you need to know is this. There were 248 rigs drilling in the beginning of the year in Saudi. Ignore the Baker Hughes rig count. It's never been right. They do not include a lot of things. It was 248 in the beginning of the year. Today, it's fallen by about 37 rigs, but they're actually going to add 8. So they're actually going to get down to about 228. So roughly a 12% reduction in overall land activity in Saudi. That's kind of roughly where we think the overall market is shaking out. Yes, it's dialed back a little bit, but only about 10, 15%. We think it's going to kind of stay at those levels and stay fairly steady. It's a much smaller market. There's, for service companies, I'm not dealing with 100 different other players out there. Pricing, pricing's always tough, especially right now. This is what the Saudis do. There'll be a slow drag. There's a reason why they're slowing down, because they want to bring you to the table. They want to negotiate with you. So pricing, ever since my first trip to Saudi Arabia in 2008, I think pricing has gone in every year. It's always gone down every year. So just kind of keep chipping away at a little bit. That being said, I think is a very, very resilient market, and I continue to see that going forward. We don't have as much visibility on Russia, but that seems to be holding up pretty well. But overall, what we heard is it's going to continue to slow down a little bit more. It's not maybe a little bit worse than we thought, but on balance, we see spending down about 15% internationally. But Saudi, Kuwait, UAE, all those markets are holding up pretty well.
That's really great perspective. I want to, before we end time here, jump on to one of the topics that I think has been certainly a stable topic for the capital markets, certainly the E&P. And I think it also flows into oil field service, and get your perspective on the ESG, environmental, social, and governance, and how are oil field service companies and the companies you covering using that or working with that and their access to capital markets?
So this is where I think our perspective as a global bank really helps. If I didn't speak to my colleagues in the UK, I probably would be saying this is all overblown. And, what are we talking about this for? Hell, I get a lot of US investors kind of tend to roll their eyes when they talk about ESG stuff. All you got to do is spend a week in Europe and talk to energy investors over there. And you get a very, very different perspective of where the market's going. What BP is doing, for instance, is that seems to be kind of something that's on the minds of every European investor right now. BP is cutting, I believe they had said they're cut 17,000 heads out of the upstream market. They're becoming a new company, really focused on renewables, focused on hydrogen, the new hydrogen economy and all this other stuff that's happening. There is a momentum that's happening for this, and I don't think it is really going to turn around. Does it matter to the UK a lot more than the US? Absolutely. Is that going to be part of every investor's, checkbox? I don't think so. But I do think that portfolio managers, as they're considering different investments, this is going to be more and more part of their process. And I think that's the most important thing. So we did a pretty big report about 2 months ago, which looked at the entire industry, the entire chain. I'll just tell you from my perspective on the service companies, some of the big guys are starting to do this, but I think the biggest problem right now is measurement. Nobody can measure the data. So in order to manage it, you need to measure it. And if you can measure it and manage it, then you can guide to it. Then you can actually set policies for it. And then the only company that we know of that has ESG metrics in their compensation is Schlumberger. Now, Schlumberger is also the only one who's agreed to go out there, and they've gone much further than other companies in going and accepting the Paris Accord, the Paris Climate Agreements. They are putting out Scope 1 and Scope 2 numbers very consistently, but it's bits and pieces. So they're starting the process, they're gathering the data, and they're trying to create kind of a framework for ESG and ESG investing. Some of the biggest problems for this for our companies is the Scope 3. I mean, the Scope 3 is sort of, basically is the consumer. So, blaming Schlumberger for you and I driving our cars is kind of perverted logic, I think, in terms of, and I don't think that's really the goal for this, but I would just say that the management companies that I speak with from the big service companies have all bought into this. They believe in this. They think it is real. They think it is something they have to pay attention to. And they're starting to collect data, and they are going to be managed. I think you can see more and more out of this over the next coming years, but it's early days. But it's something you need to. And this is actually why I talk about, digital, because I think some service companies play a big role here. Service companies can be the one to shrink your well site. This goes back to what we're talking about digital, remote operations, shrinking the well site, taking people off the well site, getting more efficient, tracking emissions, predictive failure, as I said. If you can prevent that next, chemical plant explosion, I mean, you should get some sort of benefit from that from an ESG standpoint. I don't think we're there yet. I don't think investors think through like that, but digital to me is completely enabler for ESG. I don't think the mindset is there yet, but that's how I view it. So I think ESG from a US investor standpoint, let's just say it's still pretty low on my day-to-day conversations with investors, it's pretty low. But when you start talking to the PMs who are thinking about investing for the next 2 to 3 years, and what is their portfolio going to look like, and how does it evolve, I think that does matter. I think they are considering that. But there's one other major point about this. A lot of the ESG stuff is basic common sense. Okay, it's also just strong corporate management. So it kind of goes hand in hand. A company that has strong ESG is going to have a strong board, is going to have a strong management team anyway. So it all kind of works together. So if you have strong ESG, I think it's almost a strong litmus test for the quality of the company. So that might be a little different way to think about that.
No, absolutely. And I think that, good companies have always had good ESG because that's how you run a good business. Right. And, I think oilfield service has an opportunity to partner with their E&P operators and kind of work together on both of those to help on both fronts. So I'm going to leave it there and really appreciate your time, David, and your insight. It's been incredible and appreciate the data. So thanks for joining us.
Well, thanks for the opportunity. And I hope I'm out in Denver next year to be there in person. Trust me, I miss getting on. I don't necessarily miss the planes themselves, but I certainly do miss going out there, kicking tires and seeing people and talking to people in the field. And that's been a tough one for me. Probably the hardest part about this.
I got to say, I'm right there with you. I hope next August we're all sitting around the West and having a beer together and discussing how we're on an upswing.
Oh, I hope so. I hope so.
All right.